Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what are the golden rules of stock market trading? Answer by Abhishek Kar. Golden rules of stock trading. Well, I have answered so many questions related to stock markets now, that I want these famous people to now lay down the foundation for you. So, listen to these superstars while they run you through the golden rules of stock market trading. I will help you to interpret those. The founder of Apple laid down the first rule, think different. Interpretation, if you continue to follow what others have been doing in the markets, i.e., following tips, looking for TV analyst recommendations and gambling without knowledge, you will surely make losses. So, start thinking differently, learn and make your own unique trade setups. This rich man and the most influential figure in Silicon Valley laid down the second rule, patience is the key element for any success. Interpretation, in stock markets, big money is made only with patience. Patience is a commodity which is rare in existence these days. So, start building up more of it if you wish to be successful in the stock markets. He just replaced Bill Gates as the richest person walking on this planet, and since markets are also about making money, so it makes sense to listen to this gentleman who lays down the third rule. If you don't understand the details of your business, then you are soon going to fail. Interpretation, in stock markets you should be good with your concepts, technicals as well as fundamentals. If you have partial knowledge, it's too risky. Talking about businesses, since in markets you invest primarily into stocks of companies, hence you should have in-depth knowledge about the company in which you will be investing. The list would remain incomplete without the man himself who made all his fortune using stock markets. Here are his wisdom words as the final and fourth rule: be greedy when others are fearful and be fearful when others are greedy. Interpretation, most people do the mistake of booking losses when markets fall and buying when markets are in frenzy mode. The idle way to make money is sell when there is euphoria and buy when there is blood. Simple. Now that these legends themselves have revealed the truths and golden rules of the market, all you got to do is start following these. Main thing boils down to execution. For more informative stuffs, make sure you leave a review and like Abhishek Kar, and to gain knowledge in the video format, don't forget to subscribe my channel which I recently launched with the name Abhishek Kar's Academy, aka Trade Guru. Answer by Mahesh Warrior. Golden rules of stock market. However, the investors who put in money systematically, in the right shares and held on to their investments unwearyingly have been seen generating outstanding returns. Hence, it is discreet to have patience and follow a disciplined investment approach besides keeping a long-term wide-ranging picture in mind. Never time the market, even if you are an expert investor having a bird's-eye view about the price levels related with individual shares. Still catching the tops and bottoms is a myth. Even Warren Buffett didn't try to time the market, and doing this will lead to loss of your money. Pick source Google. Stock trading rules, financial health, management assessment, share price value, liquidity, share price sentiment, market capitalization, principal activities, news and announcements. Follow all rules. Stock market investment is both easy and challenging. If you know the rule of the game, then stock market investment is a cakewalk. Let me acknowledge that only smart investors can make money in the stock market. At the same time, no one is born smart investor. Investors learn from their mistakes and graduate to smart investor. The stock market can be an excellent place to invest over the long term to create wealth. But in order to reap the benefits of investing in the stock market, investors should learn as much as possible about the market before investing. Don't buy on tips. Don't invest in a company you don't understand. Don't confuse investing and trading. Don't dread at short-term trouble when your goals are long-term. If you need cash in short-term, don't invest in stocks. Don't have excessive expectation about returns. Don't invest without a plan. Pick source Google. To create wealth and avoid pitfalls of emotional decision-making, a simple mantra can be: thoroughly cross-check fundamentals and sentiments before stock selection. Gauge how the possible loss on the investment will affect you. Have realistic return expectations. Here's some golden rules. Avoid the drove mentality. No need to say that you should always avoid having the herd mindset if you don't want to lose your hard-earned money in stock markets. Take informed decision. Proper research should always be undertaken before investing in stocks, but this is hardly ever done. Invest in business you understand. Never invest in stock, Invest in business substitute and invest in a business you understand. Follow a disciplined investment approach. The volatility witnessed in the markets has predictably made investors lose money despite the great bull runs. Do not let emotions puff your judgment. Many investors have been losing money in stock markets due to their lack of ability to control emotions, particularly fear and insatiability. Create an extensive portfolio. Level of diversification depends on each investor's risk-taking capacity. Invest only your surplus funds. If you want to take risk in a volatile market like this, then see whether you have surplus funds which you can afford to lose. Monitor austerely. We are living in global village. Any important event happening in any part of the world has an impact on your financial markets. Pick source Google. Never trade without stop loss. Stop loss should not be more than 3% of capital. The best stocks to trade are stocks which gives an all-time high breakout. Don't become an investor when you see your open position in a loss. Key factors in selecting runaway stocks: accelerated earnings, hot-headed price moves, new price highs, high relative strength. Finally, if you want to invest in stock market, first learn more about stock market and start investing. If you're a beginner, then do intraday, futures and options. Just do investments. Learn stock market lessons free at Zero the Varsity tool, and where investments or delivery are completely free. Zero brokerage. Open an online trading and demat account with Zerodha and enjoy the lowest brokerage. Thank you. Answer by Chintan Chheda. Golden rules of stock market trading. Avoid herd mentality. Never trade on tips and avoid listening to other for trading ideas. Understand your core competencies. Never try to invest or trade in the stock market with stocks whose business you don't understand or know nothing about. Gather enough information before taking decision. Taking informed decision is very important. Without that, you might end up taking wrong decisions. Gather as much as information possible from direct as well as indirect sources. Most of the time, first-time investors collect only the financial ratios in sector and industry to understand and invest in the stock market. Timing the market. Never try to time the market. Even people who are able to predict the stock market correctly do not time the market. You may end up being more wrong than correct. So, you should never try to time the market. In fact, nobody has ever done this successfully and consistently over multiple business or stock market cycles. Catching the tops and bottoms is a myth. It is so till today and will remain so in the future. In fact, in doing so, more people have lost far more money than people who have made money, says Anil Chopra, Group CEO and Director, Bajaj Capital. Disciplined trading approach. Many first-time trader change the entire entry and exit during the live trade. Loss-making trades are often do not have stop loss, or else the stop loss is extended quite often or changed very often. Emotions taking over your judgment. Many traders get very emotional with their trades and start taking personally. They often forget that they are in the stock market to make money and not to be right. Broad portfolio. Have a broad trading portfolio is very important, since if you are dependent on a single strategy and single source of income, that at times certain strategy might be on the downside or giving negative returns. In case of broad portfolio, chances are that one's losses is managed and by others' profit. Realistic expectations. Have an annual return goal for your strategy rather than monthly and weekly goal. Many traders want to double their money with the first year of trading. Some of the best portfolio managers in the world are generating a return of 40% CAGR. Invest amount from savings. Never borrow money for investing in the stock market. At the same time, do not over-leverage in the stock market with your current investments. Monitor. It is very important to always keep an eye on your stock holdings all the time. If you can't even do that, then stock investing is not for you. Better put your money in safe or less risky instruments, advises Kapoor. Even sometimes blue chip stocks can give you blues. In the year 2009, Econ was everyone's favorite and all-time high, has lost 95% of the wealth in the last decade.